So, imagine for a second that a single shipment of computer chips is delayed, just by like 5 days.
Right. Which sounds like nothing.
Exactly. But then, I mean, a week later, your personal retirement account just loses 30% of its value.
Oh, wow.
Yeah, and your local auto manufacturing plant shuts down indefinitely. And suddenly, two global superpowers are literally standing on the absolute brink of a kinetic war.
It's terrifying when you frame it like that.
It is because, we like to think of the world in these isolated, neatly organized categories. Like you look at your bank account and that's just personal finance.
Right. It's just your own money.
Yeah. And then you read a headline about some crazy new artificial intelligence breakthrough and you just file that away as a tech story. Or, you see news about naval ships posturing in the South China Sea and that's geopolitics.
You put them in different mental buckets.
Exactly. They feel like completely separate worlds. But the thing is, they aren't. They are interconnected gears turning in the exact same economic machine.
Yeah. And I think it's a comforting illusion to categorize them like that. It makes the sheer, just overwhelming complexity of the modern world feel somewhat manageable.
Because otherwise it's just too much.
Right. Because if you isolate the variables, you don't really have to confront the reality of how fragile the entire system actually is. But the moment you strip away those categories and just look at the raw macroeconomic data, you realize something huge.
Which is what?
That history isn't just this series of random, chaotic events happening one after another. There is a deeply structured, heavily deterministic framework at play here.
And that framework is exactly our mission for this deep dive. We are welcoming you, the listener, to an exploration of how the current AI boom, the shifting of global superpowers, and literally the purchasing power of the money in your wallet right now, how all of that is intimately connected by a single, highly predictable historical cycle.
It's an incredibly powerful concept.
It really is. We are unpacking a fascinating stack of sources today. They detail the macro predictions of a legendary global investor. And just to give you context on why this specific perspective carries so much weight, this is an individual who mathematically foresaw the 2008 great financial crisis.
Which almost nobody did.
Right. I mean, while the S&P 500 plunged by almost 40% and wiped out trillions, this investors fund actually produced like 9.5% positive returns.
Yeah, historically delivering something to the tune of $53 billion in cumulative net gains.
Which is just an unfathomable amount of money. So we're going to decode his sources to understand the underlying mechanics of economic bubbles, what the future of human labor actually looks like in a world dominated by algorithms, and how the entire global order is actively changing right beneath our feet.
It is a massive agenda, I know, but I'd argue there is literally nothing more vital for you to understand right now.
I agree.
Because when you finally grasp the underlying mechanics of these historical cycles, you stop being a passive victim who's just reacting to terrifying headlines. The world stops looking like a chaotic lottery.
And starts looking like an engine.
Exactly.
Yeah.
A highly complex but ultimately understandable engine.
Okay, let's unpack this by starting with the gear that is spinning the fastest and generating the absolute most heat right now. Artificial intelligence.
Yeah, this is where it gets really real really fast.
Seriously. Our sources begin by exploring the claim that we are currently witnessing the classic, undeniable signs of an economic bubble, specifically centered around the AI sector. And to understand how this works, the text draws a very specific historical parallel back to the 1929 stock market bubble.
And the 2000 dot-com bubble, right?
Exactly.
The comparison to the late 1920s is incredibly vital here. Because we often view 1929 purely through the lens of the crash itself.
Yeah, we just think of the Great Depression.
Right? We forget the environment that actually preceded it.
Mm-hmm.
If you transport yourself back to that era, you have to realize the sheer scale of the technological paradigm shift happening at that exact moment.
It was huge.
For the very first time in human history, homes were being wired for widespread electricity. And that wasn't just like a minor convenience. It was a total revolution in domestic labor and productivity.
Right. Suddenly you had refrigeration, which extended the life of food and altered supply chains.
Exactly.
Yeah.
You had automobiles rapidly transitioning from being these luxury novelties to mass-produced necessities for the middle class. You had the commercialization of radio.
Which completely revolutionized how humans consumed information, communicating across vast distances almost instantaneously. I mean, it must have felt like they had completely detached from the past and were suddenly just living in the future.
It absolutely did. And the technology was genuinely miraculous, and it was entirely real. It wasn't, snake
It
oil.
actually worked.
Yes. And here is the critical, often misunderstood point the sources make. The investors of the 1920s were not stupid. Everybody at that time knew that electricity, internal combustion engines, and radio were going to absolutely dominate and define the future.
And they were right.
They were 100% right. Those technologies did completely change the trajectory of human civilization. But, and this is where the mechanics of a financial bubble really take over, the investors completely lost sight of the fact that the price of the asset actually matters.
Ah.
They confused a revolutionary technological truth with a sound financial valuation.
Because, yeah, a revolutionary technology does not automatically equal a sound financial investment. I mean, especially if the valuation you're paying is completely detached from the mathematical reality of the business's cash flows.
Exactly.
If you pay $1,000 for a machine that only generates $1 of profit a year, it doesn't matter how revolutionary the machine is. You've made a terrible investment.
Precisely. And we saw the exact same dynamic play out during the dot-com bubble in the late 90s and the year 2000.
With the internet.
Right. The internet was a wonderful, revolutionary new technology. People looked at the early web and correctly deduced, like, hey, this is going to change global commerce. I need to bet on this.
But then the logical excitement just morphs into this psychological fever.
Exactly. People started buying into internet companies based purely on the number of, quote-unquote, eyeballs or website clicks, completely abandoning any fundamental analysis of actual revenue or profit.
They just knew they needed to get a piece of the action before they missed out. The fear of missing out completely overrides the math. And this brings us right to the present moment. Right now, there is tremendous world-altering excitement about artificial intelligence.
And according to our sources, we absolutely should be excited.
Oh, for sure. AI is going to bring about revolutionary changes to productivity, drug discovery, logistics, everything.
But because investors are so desperate to buy a piece of that automated future, they have basically stopped doing the math. The price of these AI companies just goes up, and eventually the actual profits generated by these AI models simply cannot support the astronomical prices people are paying for the equity.
And that disconnect between the required future profit and the current price is the dry tinder for a crash.
Yep. But to really understand why a bubble bursting in the tech sector severely damages the broader real-world economy, we have to talk about how people finance these speculative bets.
Right.
Because in a mature bubble, people don't just invest their excess savings, they utilize leverage. They actually borrow money to bet on the miraculous new tech.
Which leads to a really crucial distinction that the sources emphasize, and it's a concept that trips up almost everyone who doesn't look closely at corporate balance sheets. We have to differentiate between wealth and money. They are not synonyms.
Not at all. This is a foundational concept in macroeconomics, and it is entirely necessary to grasp if you want to understand how a crash functions. Wealth is basically an accounting value on paper. It's an estimation of what something is worth.
Right.
Money, on the other hand, is a medium of exchange. It's the actual liquid currency you can spend in the real world to settle a debt or buy a good.
Let's deepen this insight because it is really the linchpin of the whole bubble dynamic. The sources use a fantastic example for this. Imagine a brilliant AI company founder. They start a company in their garage, right?
Okay, yeah.
They go out and issue stock to raise capital. Let's say they raise $50 million from venture capitalists. But based on the terms of that $50 million investment, the overall accounting value, the market capitalization of the entire company is suddenly pegged at $1 billion.
Wow, okay.
So because of that new valuation, the founder, who still holds the majority of the stock, is now, on paper, a billionaire.
Right. They possess $1 billion in wealth. If you look at Forbes magazine, they are literally listed as a billionaire.
Right. But nobody actually paid $1 billion. Only $50 million of actual money was ever injected into the company's bank account. So this founder has $1 billion in wealth, but they cannot go to an aerospace manufacturer and just buy a private jet with that wealth. In order to actually spend it, to turn that abstract wealth into usable money, they have to sell their stock to someone else who has actual cash.
And that right there is the fragile link in the chain of a bubble. Because what happens when the psychological fever finally breaks?
Right.
What happens when a macroeconomic shock occurs and suddenly a massive amount of people need actual money at the exact same time?
Let's walk through the actual mathematical mechanics of a crash because it's not just about prices going down, It's about forced liquidation. Imagine you, the listener, decide to buy a unit of artificial intelligence stock. Because the market is hot, investors currently value this single share at $100.
So your net worth on paper, your wealth, is now $100.
Exactly. You're feeling incredibly confident about your financial situation.
You might even go out and, I don't know, finance a new car based on how rich you feel on paper.
Yeah, the wealth effect dictates your behavior.
Yeah.
So you feel so good that you go to a major bank, you show them your AI stock that the market says is worth $100, and you ask to use it as collateral for a $50 loan so you can buy even more stock.
And in a bubble, the bank agrees.
They agree. Now you have your original stock and you have $50 of borrowed money, which you invest. You are now utilizing leverage.
You are highly financially exposed.
Extremely exposed. Now let's look at the mechanism of a margin call. Let's say a global event occurs, maybe inflation spikes, and the central bank unexpectedly raises interest rates. Suddenly, the cost of borrowing goes up, and some investors start selling their AI stock to raise cash to pay off their other, now more expensive, debts. The price of your AI stock drops from $100 down to $60.
So it hasn't crashed to zero, but has definitely taken a hit.
Right, but here is where the mechanics take over. The bank that lent you that $50, they do not wait for the stock to drop to $25.
No, they do.
They look at your collateral, which is now only worth $60. They realize that if it drops much further, it won't even cover the $50 you owe them. So the bank issues a margin call. They call you and demand you deposit cash immediately to shore up your collateral.
But you, like most people in a bubble, have all your money tied up in the market. You don't have the cash.
Exactly. You have no cash to deposit. So what does the bank do? The bank's algorithms automatically liquidate your stock. They forcefully sell your shares on the open market at whatever the current price is just to get their $50 back.
And then you multiply this by millions of investors.
Yes. You have banks forcefully liquidating billions of dollars of stock. This floods the market with massive sell orders right when there are absolutely no buyers. Because of this massive supply of stock being dumped, the price doesn't just drop to $60, it aggressively plummets to $25.
The margin calls actively accelerate the crash.
It's a mechanical cascade. And look at the aftermath of your specific scenario. The stock crashed to $25. The bank forcibly sold it. But you still owed them $50.
Right.
The asset only covered half your debt. You are now $25 in the hole. You are entirely underwater, and your paper wealth has just vanished.
So what do? To pay back that remaining $25, you have to aggressively, violently cut your personal spending in the real economy. You cancel your vacation, you stop going out to restaurants, you put off buying that new car.
And this is how a financial bubble infects the real economy.
Yes. When you cancel the vacation, the hotel loses revenue. When you stop going to restaurants, the restaurant owner's income drops. The restaurant owners suddenly can't make their own debt payments, so they stop spending and they lay off a waiter.
And the waiter loses their income and defaults on their rent.
Exactly. The landlord can't pay the mortgage. This cascading destruction of paper wealth leads directly to a severe, self-reinforcing contraction in real-world employment and GDP.
It's just a vicious, mathematical, downward spiral.
What's fascinating here is how the supply side of the stock market actively anticipates and contributes to this dynamic, especially right now in the AI sector.
How so?
Well, we always obsess over the demand side, right? The retail investors clamoring to buy the next big tech stock. But we have to look at the supply side. The sources make a critical, almost cynical observation. There's almost nothing in the modern financial world that is easier to produce than equity.
Oh, yeah. You don't have to mine it out of the ground. You can just print more stock out of thin air with a board resolution.
Precisely. If there's a rabid, feverish market demanding AI stock, founders and private equity firms will simply create more of it to sell into that demand.
And the sources point out that this is happening right now on a massive scale.
Oh, AI company founders are raising hundreds of millions, sometimes billions of dollars in the current market. Right. And crucially, they aren't necessarily raising it because they need that specific amount of capital for immediate research or development or server costs. They're raising it simply because the money is incredibly easy to get right now. The cost of capital for them is functionally zero because investors are just throwing money at them.
So they're basically building a massive war chest.
Exactly. They are highly intelligent operators who are anticipating the exact margin call crash we just described. They know mathematically that when the bubble inevitably bursts, investors will transition from extreme greed to extreme fear overnight.
The easy venture capital money will instantly dry up.
Yep. Consumers and enterprise businesses will start brutally auditing their expenses, and they will cancel thousands of experimental AI software subscriptions. Revenue will plummet.
But by raising hundreds of millions of dollars right now while the window is open, this founder is ensuring two things, right? Survival and predatory leverage.
That's the key.
Yeah.
Predatory leverage. When their competitors begin to struggle, miss payroll, and face bankruptcy during the downturn, our founder will have the cold, hard cash on hand to simply buy up their competitors' intellectual property and talent at bargain basement prices.
So the smartest players are actively utilizing the bubble to prepare for the contraction. They are hoarding the actual money while everyone else is trading paper wealth.
Exactly.
But a bubble bursting in the tech sector and destroying all that paper wealth, it doesn't just happen in a vacuum. When these markets crash, unemployment spikes, and the real economy starts to suffocate, it forces national governments and central banks to step in and act.
They have to try and stimulate the economy to prevent a total depression.
Right. And according to our sources, those specific governmental actions trigger a much larger, much older, and frankly, far more intimidating historical clock. Which moves us from the micromechanics of tech bubbles into the next massive concept in the source material.
Yes. We have to zoom out significantly now. We're moving from the 5 to 10-year tech cycle into what the sources define as the macro big cycle.
This is a macroeconomic pattern that the sources track back over 500 years of global history. They analyze the rise and fall of the Dutch Empire, the British Empire, and the American Empire.
It's a huge scope.
Yeah, and they argue that this big cycle typically lasts for the duration of a human lifetime, so roughly 80 to 90 years on average. And the last time the world saw a major global reset of this specific cycle was in 1945 at the end of the Second World War with the establishment of the Bretton Woods financial system.
The timeline alone should give everyone listening a profound sense of pause. I mean, if the historical average of this cycle is roughly 80 years, and the last global reset was in 1945,
Yeah.
simple arithmetic tells us exactly where we are in that historical timeline today. We are entirely in the danger zone.
It places us right at the absolute tail end of the current global cycle. So we need to rigorously define what this big cycle actually is, because the sources don't just rely on a timeline, right? They break this down into 3 converging, measurable ingredients that build up over those 80 years. If we follow their logic, what is the foundational first ingredient?
The first ingredient is the monetary debt order. This is the bedrock. Over the course of an 80-year cycle, a society slowly but surely accumulates progressively more and more debt.
Okay.
In the beginning of a cycle, coming out of reset, debt is very low, and borrowing is highly productive. You borrow money to build a factory, the factory generates a 10% return, and your debt only costs 3%. That is healthy, productive debt.
Governments borrow money too, right? To fund infrastructure initiatives, fight necessary wars, provide social safety nets.
Right. And initially, this debt fuels immense economic growth and rising living standards.
But the math eventually inverts.
It invariably inverts. Over decades, society becomes reliant on debt to fund consumption, not just production. A nation eventually reaches its absolute mathematical debt capacity.
Which means what exactly?
It means the overall pile of debt becomes so massive that the cost to simply service the interest payments on that debt begins to consume a massive portion of the national budget. It squeezes out all other productive spending, like infrastructure, research, or education.
The national government effectively maxes out its credit card.
Yes.
And they find themselves trapped in a situation where they have to borrow new money just to pay the interest on the old money. It's essentially a Ponzi dynamic.
Exactly. And when a government runs out of money and hits that physical debt ceiling, they are left with very few, very painful options. They can either dramatically raise taxes, which crushes the middle class.
Or they can aggressively cut spending.
Right, which crashes the economy and removes the social safety nets that people rely on. Or they can have the central bank print money to buy the government's own debt, which causes massive inflation.
So no good options.
None. Whichever path they choose, it inflicts immense financial pain on the citizenry, which directly fuels the second ingredient in the big cycle, the internal political order.
Right, because when the money runs out, the social fabric immediately starts to tear.
We have to look at this objectively. Capitalism, by its very mechanical nature, is the most powerful engine for innovation and wealth creation humanity has ever devised. But the sources point out an unavoidable mathematical reality of the system.
Which is?
It creates massive differences in income and wealth over time. The system naturally rewards those who already own capital. This leads to profound, widening wealth gaps.
You have a very small percentage of the population accumulating massive generational fortunes, and a large growing segment of the population whose wages are basically stagnating and who feel entirely left behind by the system.
And human psychology plays a huge role here. When the economy is booming and credit is flowing freely, these wealth gaps are largely tolerated. I mean, if the middle-class worker can borrow money easily to buy a nice house and a car, they aren't marching in the streets protesting the billionaire class.
Exactly. The credit boom masks the underlying inequality. But when the debt bubble bursts, when the government hits that ceiling, the credit dries up and the economy enters a severe downturn, that tolerance just evaporates instantly. You suddenly have intense, visceral domestic conflict.
The sources describe it as people literally being at each other's throats.
Yeah, you see severe, uncompromising polarization between the political left and the political right. The politics stop being about shared national goals, and they devolve into this bitter zero-sum war over how to divide a shrinking economic pie.
The left demands massive wealth taxes and redistribution, and the right demands drastic cuts to social services and a return to hard money.
And the political center completely collapses.
Which brings us directly to the third and final ingredient of the 80-year cycle,
Mhm.
the geopolitical order.
Okay, what does that refer to?
This refers to the shifting of global power between different sovereign nations. When a historically dominant superpower is deeply indebted, struggling with massive inflation or deflation, and facing severe, paralyzing internal political conflict, they project immense weakness on the global stage. They look internally distracted by their own domestic chaos.
And nature abhors a vacuum.
Always. Other rising nations, who perhaps are earlier in their own debt cycles and possess more internal cohesion, see this vulnerability. They recognize that the dominant power is no longer willing or able to enforce the global rules, and they begin to aggressively challenge the existing world order.
So you have these three massive systemic forces building up over 8 decades, a crippling, unpayable national debt burden, severe internal political division, and populism fueled by extreme wealth inequality, and rising external geopolitical conflicts between major nations.
And when all three of those factors peak simultaneously, the sources argue the existing 80-year cycle can no longer sustain itself. The structural integrity fails, the system breaks down, and it undergoes a painful historical reset.
To make this entirely clear, I think we need to contrast this massive 80-year arc with the normal, everyday economic cycles that the listener is used to experiencing, because it's really easy to confuse a normal recession with the end of a big cycle.
That is a crucial distinction. We need to look at the mechanics of how shorter-term cycles operate within the larger arc. Let's use an analogy. Think of the economy like a massive forest.
Okay, a forest.
Within this 80-year cycle, you have smaller, roughly 5 to 8-year microcycles. These are the standard business cycles we've all lived through.
The boom and bust cycle.
Yes. An economy falls into a mild recession. In response, central banks stimulate the economy by lowering interest rates, effectively making borrowing money cheaper. This easy money acts like water on the forest floor. It fuels a rapid period of new growth and prosperity. People borrow money to buy houses, businesses take out loans to build new factories, and employment goes up.
But eventually, that prosperity overheats. The forest grows too dense.
Correct. The economy runs out of excess capacity. Everyone who wants a job has one, so wages go up. Demand outstrips supply, and you get inflation. Prices start to rise uncomfortably fast.
So to fight that inflation, central banks have to hit the brakes.
They tighten monetary policy by raising interest rates. This makes borrowing more expensive, which acts like a controlled burn in our forest analogy. It slows down the economic activity, clears out the most inefficient, highly leveraged businesses, and leads right back into a recession.
And that 6-year loop recession, stimulus, prosperity, inflation, tightening recession, happens repeatedly.
Right.
And the critical mechanical moment, as the sources point out, is that these smaller bubbles pop when the central banks hike those interest rates. We talked about margin calls earlier, but on a macroeconomic level, when rates rise, the amount of money a corporation has to pay just to service their debt at the new higher interest rate becomes greater than the profit they're generating from their operations.
They're suffocated by the cost of capital.
That is the pin that pricks the smaller bubbles.
Exactly. But here is the terrifying reality of the 80-year cycle. With every single one of those 6-year microcycles, the central banks never quite let the controlled burn do its full job.
What do you mean?
When they lower rates to stimulate the economy, they lower them a bit more than last time. And when they raise rates to fight inflation, they can't raise them quite as high as before because there's now more debt in the system.
Ah.
So across 80 years, the overall baseline level of national and private debt keeps creeping higher and higher, stepping up cycle after cycle until finally you hit the absolute ceiling.
The underbrush in the forest becomes so incredibly thick that a controlled burn is just no longer possible.
The next spark causes a century fire that burns the entire structure to the ground. That is the end of the big cycle.
So what does this all mean? I have to pause and push back on the sources here regarding the absolute inevitability of this 80-year timeline. Are we treating the global economy like a biological organism? Like a human being that is just inevitably destined to die of old age once it hits 80? Because that feels somewhat fatalistic, almost deterministic.
It does feel that way.
Surely we have highly educated, intelligent central bankers and policymakers who understand this data. Can't they implement policies to steer us away from a total system reset?
It is a very fair pushback, and it is the natural resistance anyone has when they first encounter this macro theory. We want to believe human agency can outsmart the math. But the sources clarify that it is absolutely not about biological aging. It is purely about the cold, hard mechanics of ledgers and balance sheets. Debt limits act as a physical, mathematical ceiling. It is not a subjective policy choice.
Walk me through the mechanics of that wall. Why can't we just policy our way out of it?
Because of a concept known as fiscal dominance. When a nation's debt becomes so astronomically large, the central bank actually loses its independence.
Okay, let's look at the math on that.
If a government owes $35 trillion and interest rates are at 5%, the government has to pay almost $2 trillion a year just in interest. That consumes all the tax revenue. So to prevent the government from defaulting, the central bank is forced to step in and print money to buy the government's bonds, a process called monetizing the debt.
They have to keep interest rates artificially low, even if inflation is raging, because if they raise rates, the government goes bankrupt.
They are trapped in a box.
They are completely trapped. If they fight inflation by raising rates, they crash the government and the economy. If they keep rates low to save the government, they destroy the purchasing power of the currency through inflation. They cannot escape the math.
When a society is finally forced to wipe out that crushing, unpayable debt burden, usually through massive devaluation of the currency, they essentially have to wipe out the monetary system as citizens are used to it.
And historically, across 500 years of data, when a nation's foundational monetary system breaks down, the domestic political order and the social contract violently break down with it. It is cause and effect, driven by ledgers.
And what makes this particular moment in human history so incredibly volatile is that one of those three core ingredients we just discussed, the wealth gap, the bitter divide between the owners of capital and the working class, is about to be exponentially supercharged by the very technology that is currently bubbling.
We are talking about artificial intelligence,
Yes.
which brings us to an incredibly thought-provoking and frankly alarming section of our sources.
Yeah.
The productivity paradox and what AI actually means for the future of human jobs.
To truly grasp the magnitude of what the AI revolution represents, the sources encourage us to take a massive step back and look at the long macroevolutionary path of human labor.
Like historically.
Right. If you go back thousands of years to the agricultural era, human beings essentially functioned like physical oxen. We used our bodies, our sheer raw muscle power and caloric energy to work the fields, harvest crops, and generate agricultural output. The human body was the primary engine of the economy.
And then slowly, man invented the machine.
Exactly. The Industrial Revolution came along, and machines like the steam engine, the mechanical loom, and eventually the internal combustion tractor replaced the physical necessity of human muscle.
A single tractor powered by fossil fuels could do the physical work of 100 men in a fraction of the time.
We transitioned from agricultural labor to factory labor. The machines fundamentally replaced the utility of the human physical body in the primary economic sector.
The physical body was automated, but the human mind was still absolutely required. We needed human cognition to operate the machines, to design the assembly line systems, to manage the complex logistics, and to perform the services that the industrial economy required.
Right. The premium shifted from muscle to cognition. But the sources argue that AI represents a fundamentally different and far more disruptive phase of this evolution. Because now we are looking at technology that is explicitly designed to replace the mind.
It is rapidly moving up the cognitive ladder, automating higher and higher levels of human thinking, pattern recognition, and complex reasoning.
We have to give a specific, tangible example to show you how rapidly this is scaling in the real world, and the sources provide a chilling one regarding a company we all know, Uber.
Right. Currently, there are roughly 9 million drivers around the world doing rideshare and food deliveries for Uber.
That is 9 million human beings utilizing their cognitive ability to navigate traffic, read maps, and manage their time, combined with their physical ability to steer a vehicle.
And the CEO of that company has explicitly stated on the record that he imagines a near future where those 9 million jobs will be completely 100% replaced by autonomous vehicles and autonomous robotic delivery drones.
Stop and think about the scale of that. 9 million human careers, globally, entirely eradicated by a convergence of AI brains driving robotic bodies. Now, the sources acknowledge there are massive regulatory hurdles, insurance liabilities, and physical edge cases that mean this won't happen overnight. It won't be a light switch.
But the trajectory is undeniably clear. The vast majority of point-to-point transportation and logistics will eventually be fulfilled by autonomous algorithms.
Which leads us directly into the macroeconomic mechanics of the wealth gap. We hear a lot of euphoric rhetoric from politicians and tech leaders about how AI will dramatically increase global productivity. Businesses will be able to do infinitely more, faster and cheaper. The overall GDP will explode.
But the sources ask a much more cynical, vital question. Who actually captures the financial benefit of that increased productivity?
This requires understanding how income is distributed in a capitalist system. The system is fundamentally designed to reward the owners of capital. If a business owner invests capital into a machine that increases output, the owner reaps the reward.
And the sources point out a stark, deeply concerning statistical reality regarding capital ownership in America today. While roughly 61% of U.S. adults technically own stock in some form, mostly indirectly through passive retirement accounts like 401ks, the actual ownership is incredibly heavily concentrated at the very top.
The top 10% of households currently hold almost 90% of all the stock.
Let me repeat that slowly because it is the most important statistic regarding inequality. 10% of households own 90% of the stock market.
Yes. So let's look at the mechanics of what happens when an enterprise implements AI. A massive corporation deploys AI agents in robotics to automate 40% of its white-collar workforce, its coders, its customer service reps, its middle managers.
The company's productivity skyrockets and its payroll costs absolutely plummet. The profit margins explode.
But the share of the company's revenue that traditionally went to the workers in the form of wages goes down to near zero for those displaced. Meanwhile, the share of the revenue going to the business owners, the capitalists and shareholders who deploy the AI, goes up exponentially in the form of dividends and stock buybacks.
So AI doesn't just increase productivity, it violently accelerates the transfer of wealth from the labor class to the capital class. It detaches labor from the production of wealth.
Precisely. Economists call this the decline of the labor share of income. And this unprecedented technological wealth transfer is happening at the exact moment when we are already near the end of an 80-year debt cycle, where wealth inequality and political polarization are already at historical powder keg highs.
I want to aggressively push back here again because there is a very loud, very persistent narrative constantly broadcast out of Silicon Valley regarding this exact issue of automation. Whenever tech CEOs are confronted by Congress or the media with the threat of mass technological unemployment, they always point to the historical record.
Right, they say, look at the Industrial Revolution.
Look at the Luddites. When tractors replaced farmers, people thought it was the end of the world. They thought mass starvation was imminent. But we just invented new, complex jobs that we couldn't have possibly forecasted at the time. We became software engineers, graphic designers, and marketing managers. AI will just create new, better, more fulfilling jobs for everyone. It's just a transition.
It is an incredibly comforting narrative, and it is certainly a convenient narrative for the individuals who are actively building and profiting from the technology today. They need the public to believe that.
But if we follow the cold logic of the sources, if AI fully replaces the human mind's ability to reason, code, and analyze data, and advanced robotics replace the human body's ability to move, lift, and assemble, what exactly does a human being have left to sell in the economic marketplace?
It is the defining existential economic question of our era. If you automate both the muscle and the mind, what is the residual value of a human worker?
How do the sources even attempt to answer that?
They attempt to answer this by suggesting that what remains uniquely, irreducibly human are emotions and intuition. There are deeply interpersonal, empathetic, and spiritual aspects of the human experience that algorithms, no matter how advanced, cannot authentically replicate or experience.
So their economic solution is that we all just become therapists, life coaches, and massage therapists for the 10% who own the robots.
It sounds slightly absurd, perhaps even dystopian, when phrased that starkly. But there's a profound macroeconomic truth there regarding the future premium on authentic human connection. If intelligence becomes a cheap, abundant commodity generated by servers, then human empathy becomes the scarce luxury good.
Interesting.
However, the sources are deeply, brutally pragmatic about the societal implications of this transition period. They argue that as this massive shift occurs and millions of legacy jobs are destroyed before the new paradigm settles, society absolutely must, for its own survival, create a floor for its citizens.
Define exactly what they mean by a societal floor. We aren't just talking about universal basic income, are we?
A floor means a guaranteed baseline foundation of adequate education, healthcare, and housing, the basic foundational requirements for a stable human life. And the sources frame this not as a moral imperative of charity, but as a cold, calculated economic necessity.
Because they are very clear. If you allow a large percentage of your population to fall below that floor, if you allow them to become entirely economically disenfranchised by AI and crushed by the debt cycle, society pays a terrible, incalculable price.
Those individuals transition from being productive, tax-paying assets to the society into becoming massive systemic liabilities and sources of severe, violent disruption.
And the sources use a hyperlocal, highly specific example to illustrate the mechanical cost of failing to provide this floor. The legendary investor who provided these sources actually lives in Connecticut.
Right.
On a per capita income basis, Connecticut is routinely ranked as the second richest state in the United States. There is immense, staggering wealth concentrated in hedge funds and estates there.
But the sources point out that within that exact same incredibly wealthy state, just miles away from the mansions, you have public school districts where 22% of high school students are either dropping out entirely or failing their classes, with chronic absenteeism rates greater than 25%.
It is a staggering structural failure of the educational floor. And what is the direct, measurable, mechanical consequence of that specific failure? The sources trace the ledger. They note that this lack of education and economic opportunity leads directly, predictably, to gang affiliation, violent shootings, and the proliferation of drug epidemics.
Which, in turn, leads directly to mass incarceration. And the ultimate tragic mathematical irony that the sources highlight is that the state's financial bill for policing and incarcerating its failed citizens has actually grown to become larger than the state's entire public education budget.
They are spending more taxpayer money to lock human beings in cages after they fail than they are spending to educate them so they can succeed in the second richest state in the nation.
It perfectly illustrates the macro theme. If you do not establish a societal floor and invest capital up front in making people productive, the resulting internal conflict and criminal justice cost will financially bankrupt the system anyway. You pay for it one way or another.
Exactly. The ledger always balances. It ties directly back to the second ingredient of the 80-year big cycle: internal political conflict and societal breakdown driven by severe wealth gaps. When the economic system stops working for the vast majority of the people, the public order breaks down.
So we have established a rather intimidating, frankly terrifying, macroeconomic picture.
We really have. We have a potential AI stock bubble ready to trigger a massive cascade of margin calls, an 80-year sovereign debt cycle hitting an impenetrable mathematical wall, and a technological revolution threatening to automate both human cognition and physical labor, exponentially supercharging wealth inequality.
For you, the listener sitting in your car or at the gym right now, the obvious screaming question is, how on earth do I protect myself, my family, and my assets in this environment?
Which brings us to a highly actionable section of our sources, the Individual Survival Guide.
This is where dense macro theory meets practical, everyday reality. The sources are not just academic. They offer very clear, actionable takeaways for navigating this specific type of historical turbulence. And the primary, overarching, non-negotiable rule for the individual investor in this environment is simple but absolute: diversify.
Because, as the sources emphatically emphasize, you cannot time the market. Even the most sophisticated institutional quantitative funds in the world, backed by supercomputers, have a nearly impossible time predicting exactly which day or which month a bubble will pop, or exactly when a central bank will lose control of the bond market.
So if you acknowledge that you cannot time the crash, you must structure your life to survive the impact whenever it arrives.
And true survival requires fundamentally understanding the mechanical nature of different asset classes. Let's start with the most common and perhaps most dangerous psychological misconception. The sources are adamant about one mathematical reality. Cash is trash.
This runs completely, 100% counter to basic human psychology. When the world feels risky, when geopolitics are unstable and the stock market looks frothy, people instinctively want to hold cash. They want to liquidate their investments and leave their money in a basic savings account because it feels physically safe. The number on the screen doesn't go down. It isn't volatile.
It feels safe, yes. But the sources explain that mathematically, leaving your wealth parked in fiat currency in a bank is actually the absolute worst long-term investment decision you can make during the end of a debt cycle. And the reason is the silent, compounding thief of inflation.
Let's walk through the actual math on this, because we aren't just talking about basic inflation. We are talking about real yields and fiscal dominance. Let's say inflation is running at 4% a year, which is roughly where the sources imply it will settle as governments monetize their debt.
If your money is sitting in a traditional checking account earning zero interest, you are mathematically guaranteed to lose 4% of your purchasing power every single year. You are bleeding wealth.
But the savvy listener will immediately counter, well, I'm not stupid. I won't leave it in checking. I'll put it in a money market fund or a high-yield savings account or a short-term government bond earning 4.5% or 5% interest.
Which superficially sounds like you are beating inflation. You are making 5%, inflation is 4%, so you are up 1%. But the sources remind us of the tax man. You have to pay taxes on any nominal interest you earn.
Let's assume a conservative 25% tax bracket. You earn 5% interest on your cash. The government taxes away a quarter of that gain, leaving you with a 3.75% return.
But inflation is still 4%. So after inflation and taxes, your real yield is negative 0.25%.
Exactly. You are still losing purchasing power in real terms, just slightly slower. The crucial insight here is understanding why this happens. The government has massive debts. The only way they can shrink the real burden of that debt without officially defaulting is to keep interest rates slightly lower than the rate of inflation.
They are essentially utilizing inflation to silently default on their massive debt burden, and anyone holding cash or fixed income bonds is the one paying for it. Cash is a mathematically guaranteed path to slowly going broke over a long timeline.
So if holding cash guarantees a loss of purchasing power, you have to invest. You have to buy tangible assets that benefit from human productivity and economic growth, which traditionally means equities and real estate.
But here we encounter the extreme volatility we discussed in the bubble section. The sources warn that during the chaotic bust phases of these 80-year cycles, during severe structural bear markets, broad stock indices can plummet by 60% to 70%.
And a 70% drop in your life savings is a catastrophic, unrecoverable event for an individual nearing retirement. So the question becomes, how do you mechanically offset that massive equity risk?
This is where the sources dive into a fascinating, highly relevant comparison between traditional safe havens and modern digital alternatives. Specifically, they rigorously compare the utility of gold versus Bitcoin during a systemic crisis.
This is a highly debated, almost religious topic in finance right now, and it is important to impartially report exactly how the sources evaluate the mechanics of these two assets without taking a side.
Let's look at the sources' view on gold. They view gold as a historically reliable, battle-tested asset. It has a continuous 500-year track record as a store of value. In fact, gold was literally considered base money on a global scale prior to the U.S. closing the gold window in 1971.
Furthermore, central banks around the world, specifically in the East, like China and Russia, currently hold thousands of tons of gold as their primary reserve asset outside of the dollar.
It is a recognized foundational asset for sovereign nations. It has zero counterparty risk. If you hold physical gold, you don't rely on a bank's promise to pay you.
And crucially, historically, gold tends to perform exceptionally well precisely when fiat currencies are being debased and stocks and bonds are failing simultaneously. When the system is shaking, gold holds its purchasing power.
Now, let's compare the mechanics of that to Bitcoin. The sources fully acknowledge the innovation of Bitcoin. They recognize that it represents a new kind of digital hard money. Like gold, its supply is strictly mathematically constrained to 21 million coins. Central banks and governments cannot simply print more of it to fund their deficits.
It has the massive appeal of being a decentralized, permissionless asset completely outside of traditional central banking control.
However, the sources highlight several severe mechanical risks associated with Bitcoin that make it, in their specific view, a less desirable safe haven than gold for preserving wealth during a sovereign crisis. First is the technological risk. The sources point to the vulnerability of future technologies, specifically quantum computing.
Let's explain the mechanics of that threat. Bitcoin relies on advanced cryptography, specifically elliptic curve cryptography, to secure private keys. Right now, it would take a traditional supercomputer millions of years to crack that encryption.
But the sources note that quantum computers, utilizing what's known as Shor's algorithm, could theoretically factor the prime numbers behind this cryptography in a matter of hours. If a bad actor or a hostile nation-state develops a sufficiently powerful quantum computer before the Bitcoin network upgrades its security, they could theoretically steal massive amounts of Bitcoin, completely destroying trust in the network's immutability.
That is the tail risk technological threat. But the far more imminent, significant risk, according to the sources, is regulatory. Governments, by their very nature and design, require absolute control over private transactions, taxation, and capital flows, especially during times of severe economic crisis.
If a government decides that Bitcoin is a legitimate threat to its sovereign monopoly on money, or if it simply wants to prevent desperate citizens from moving their capital outside the banking system to avoid a wealth tax, the government has the absolute power to heavily regulate it, tax it punitively, or outright ban its conversion back into fiat currency.
And because the world's central banks do not hold Bitcoin in their sovereign reserves, it completely lacks the institutional state-level protection that gold enjoys. If a government banned gold, they're banning their own reserve asset. If they ban Bitcoin, they're just banning a competitor.
Exactly. So the blueprint for the individual portfolio, according to the sources, is a highly balanced, risk-weighted mix. Some physical real estate to utilize fixed-rate debt as a hedge against inflation, a globally diversified basket of equities to capture long-term productivity and AI growth, and a percentage of hard money, specifically assets like gold, to act as an uncorrelated parachute when the highly leveraged equity markets go into freefall.
That is the financial survival guide. But the sources also address the career survival guide. Because, as they rightly point out, for a 30-year-old listener with very little accumulated financial wealth, their primary economic asset isn't a stock portfolio. It is their own human capital. It is their ability to generate income in the labor market.
Here's where it gets really interesting. Because the sources introduce a concept about how the macroeconomic labor market actually values individual skills. It expands on the idea we touched on earlier regarding human value in the age of AI.
I want to bring up a specific mechanical analogy for this. Think about the physical and cognitive skill of driving a vehicle. The core competency steering, braking, spatial awareness is identical whether you are driving a 10-year-old Honda Civic or a brand new Mercedes.
But if you deploy that exact same skill by driving for the Uber algorithm, you are paid absolute pennies on the dollar because you are competing against millions of others in a commoditized market.
But if you deploy that exact same physical skill to become the trusted personal executive chauffeur for a billionaire hedge fund manager, the pay is wildly different. The compensation is exponentially higher. The exact same human skill is valued completely differently depending entirely on the context, the network, and the specific industry it is deployed in.
That is a profound realization for career planning. You must constantly audit not just what your skills are, but what sector of the economy currently places the highest premium on those specific skills. And this ties directly into what the sources define as the law of everything.
What are the mechanics of the law of everything?
It is the mathematical observation that those functioning at the absolute top tier of any given field command financial premiums that are massive, non-linear multiples of the average. Whether the market is pricing a piece of fine art, a parcel of commercial real estate, or a person's cognitive time, the top tier is exponentially more valuable.
The sources suggest a specific heuristic. Investing just 10% more effort, time, or highly targeted skill acquisition to elevate yourself from the 80th percentile to the 99th percentile of your profession can result in commanding a wage premium that is twice as high as the average. A marginal 10% improvement in unique capability yields a 100% increase in economic compensation.
That is incredible leverage. But how do you practically find the endurance and motivation to continually exert that extra 10%, especially when competing against AI?
The sources argue it requires a deep understanding of your own nature. You have to align your career path with your inherent baseline personality. Whether you are naturally adventurous and risk-seeking, highly conceptual and abstract, inherently artistic, or someone who deeply craves concrete, methodical certainty.
Yes, because humans possess neuroplasticity. We can learn, adapt, and force ourselves to do jobs we hate. But we are only maximally effective and capable of reaching that top 1% when our daily work aligns with our underlying nature. The friction is removed.
The sources stress that to survive the AI transition, you must maximize this adaptability. The future is unwritten. The most lucrative jobs of tomorrow literally do not exist today.
Therefore, your goal shouldn't be to pick the perfect static job title. Your goal should be to become relentlessly adaptable, to learn how to rapidly master new digital tools, and specifically to learn how to partner with AI rather than stubbornly competing against it.
The individuals who can wield AI as an operational tool to radically enhance their uniquely human traits, their empathy, their strategic vision, their complex problem solving, will be the ones who reach that top tier and command the extreme premium.
So an individual listener can adapt. A person can learn a new skill, they can change industries, but they can literally pack up and move to a new city to protect their family. But what happens when an entire sovereign nation fails to adapt?
What happens when a country hits the absolute end of that 80-year debt cycle, refuses to make the mathematically required hard choices, and begins to fracture?
This transitions us to the final and perhaps most consequential systemic section of our sources: empires in decline and the new geopolitics.
To deeply illustrate what the chaotic late stages of the 80-year cycle look like on a national level, the sources point directly to the United Kingdom as a stark, real-time cautionary tale.
The sources are incredibly blunt, almost clinical, about the UK's current macroeconomic status. They describe a nation that is actively exhibiting all the classic historical markers of a state late in its cycle.
It is massively over-indebted relative to its GDP. It has become structurally underproductive relative to its global peers. Business investment has flatlined. And as a direct mechanical result of having run out of fiscal choices, it is experiencing severe, crippling political volatility.
The primary statistic they highlight is absolutely damning for a developed G7 nation. The UK has had 6 different prime ministers in the span of just 7 years.
It is a complete revolving door of leadership. And the mechanics of why this happens are exactly what we discussed earlier regarding the debt ceiling. Let's look at a specific recent example that proves this cycle: the Liz Truss administration.
She came into power promising to fix the stagnant economy. Her proposed solution was massive tax cuts to stimulate growth. But because the country was already burdened by massive debt, her government simply didn't have the revenue to fund those tax cuts. They were going to have to borrow billions more to pay for them.
And here is where the mechanics of the market violently reject political promises. When she announced those unfunded tax cuts, the global bond market looked at the UK's ledger and panicked.
Investors realized the UK was going to issue a flood of new debt. So investors immediately started dumping UK government bonds, known as gilts. When bond prices crash, the interest yields skyrocket.
This sudden, violent spike in interest rates nearly caused the entire UK pension system to collapse in a matter of days due to complex derivative strategies they were using.
The Bank of England had to step in with an emergency bailout to save the pension funds, and Liz Truss was forced to resign after just 45 days in office.
The market literally vetoed the prime minister. When the promises fail to materialize or the market rejects them, the public becomes furious. Internal conflict spikes, and that leader is thrown out, only to be replaced by another who will face the exact same impossible mathematics of high debt and low growth.
And this sheer political desperation for revenue invariably leads to fierce, highly polarized debates over taxation. When a government is functionally broke and the bond market refuses to lend them more cheap money, the politicians must look for where the money currently resides within their own borders.
This brings us to a highly contentious, increasingly prevalent topic covered in the sources: the debate over wealth taxes.
We need to address this impartially, exploring the actual economic mechanics of both arguments, as laid out in the source material, because this debate isn't just happening in the UK, it is happening globally, from Parliament to Washington, D.C., to local municipalities in New York and Los Angeles.
Let's start with the mechanical argument for implementing a wealth tax.
Yeah.
Proponents, as cited in the sources, argue that if you do not heavily tax individuals with net worths exceeding, say, $10 or $50 million, the natural compounding mechanics of capitalism, the fact that capital returns outpace economic growth, will ensure that their share of the economic pie continues to grow exponentially.
This unchecked generational accumulation of wealth at the very top ultimately squeezes out ordinary families, buying up real estate and assets, destroying the middle class, and creating the exact societal instability and political populism we talked about earlier.
The stated goal is to use the tax code to forcefully stop the hoarding of enormous wealth over enormous amounts of time and redistribute it to maintain the societal floor.
So the intent is to forcefully redistribute the pie to maintain stability, but then the sources detail the mechanical arguments against wealth taxes. What happens in reality when a government actually tries to implement this?
The sources outline several massive operational and macroeconomic hurdles. First, as we established in the bubble section, wealth is not liquid cash. If a government taxes a billionaire based on the paper value of their private company's stock or their real estate holdings, they are forcing that billionaire to sell a portion of that illiquid stock to generate the actual cash required to pay the tax bill to the IRS.
And if you force massive synchronized selling of assets across the entire billionaire class to pay wealth tax, you can accidentally pop economic bubbles, crash the stock market, and wipe out the retirement accounts of the middle class in the process.
Exactly. The cure can trigger the disease. Secondly, and more dangerously, the sources argue that the ultra-wealthy are highly hypermobile. If you implement a punitive wealth tax in one specific jurisdiction, the wealthy will simply pack up their families and their capital and legally relocate to a more favorable tax zone.
But the government won't just let that capital walk out the door, will they? And this is where the mechanics of capital flight become devastating for the average citizen. If a billionaire decides to leave the UK, they don't just pack pounds in a suitcase. They sell their UK assets, take their billions of British pounds, and they sell them on the foreign exchange market to buy US dollars or Swiss francs.
This massive wave of selling violently depreciates the value of the pound. Now, the UK, which has to import its food and energy priced in global dollars, faces massive inflation because their currency is weak. The middle class pays for the billionaire's capital flight via inflation at the grocery store.
That is the exact mechanism. And that is why the cycle gets truly dangerous. To stop the currency from crashing and the wealth from fleeing, governments are forced to implement extreme, often draconian measures.
The sources cite historical examples from previous debt cycles where governments enact capital controls, literally making it illegal for citizens to transfer their own money out of the country. They implement massive, punitive exit taxes. They even change tax laws retroactively, claiming that you owe taxes based on wealth you held in the past, even if you try to renounce your citizenship now.
Furthermore, if you take capital away from private investment and merely use it for government transfer payments consumption, you risk further undermining the overall productivity and innovation of the entire society.
It becomes an economic hostage situation, born entirely out of a nation reaching the end of its debt capacity. And while the sources use the UK as a vivid current example, they are very clear, mathematically, that the United States is also traveling down this exact same historical path.
Yes. The sources state unequivocally that the United States is currently transitioning deep into the decline phase of its 80-year cycle. And they stress that this is not a subjective, partisan political opinion. This conclusion is based on comparing current data to historical data spanning 500 years of empires.
The markers of decline, the soaring parabolic levels of national indebtedness, the declining educational outcomes relative to emerging global peers, the loss of manufacturing competitiveness, and the extreme internal political polarization. These are objective, measurable statistics on a ledger.
If we connect this to the bigger picture, what does it mean for the entire world when the dominant superpower for the last 80 years enters a measurable, undeniable phase of decline?
It means the fundamental rules of how the globe operates are going to structurally change. Since World War II, the United States has championed and enforced a rules-based order. The concept is that international relations, trade, and borders should be governed by agreed-upon laws, treaties, and representative bodies like the United Nations and the World Trade Organization.
It's a beautiful, stabilizing theory.
It is, and it facilitated decades of global growth. But the sources are brutally pragmatic historians. They point out that a rules-based order only functions when the dominant power is economically and militarily strong enough to unilaterally enforce it. When the agreed-upon rules conflict with raw, geopolitical power, power always wins.
As the U.S. declines in relative economic and military power, distracted by its own internal debt and political crises, that rules-based order begins to fracture. Other nations realize they no longer have to comply with Washington's dictates.
The sources suggest we are rapidly moving away from a one-world order dominated by a single, unipolar superpower and transitioning into a highly fragmented world of regional powers. For example, a U.S.-dominated sphere of influence in the Americas and a Chinese-dominated sphere of influence in the Asia-Pacific region.
But history emphatically tells us that these transitions of global power are rarely, if ever, peaceful. The most terrifying question posed by the sources is about the rising threat of kinetic war. The sources specifically address two major geopolitical flashpoints where this transition is currently playing out: Taiwan and Iran.
Let's rigorously look at how the sources analyze these threats, because it is fascinating and deeply concerning. Let's start with Taiwan.
The conventional fear regarding Taiwan, fueled by media headlines, is a massive, direct military confrontation, an amphibious assault by China, met by the United States Navy, sparking World War III. But the sources suggest a different, far more likely and perhaps more economically insidious vulnerability.
They believe the conflict will likely take the form of immense asymmetrical economic pressure aimed at forcing a political reunification rather than a traditional hot war. And the specific, critical vulnerability they highlight is semiconductors or computer chips.
Taiwan, specifically the company TSMC, produces the vast, overwhelming majority of the world's most advanced microchips. They are the bedrock of the modern digital economy. The sources pose a terrifying, highly plausible hypothetical. What if China simply instituted a naval and airspace blockade on chips leaving Taiwan for just 5 days?
Let's trace the mechanics of that contagion.
Huh.
Why is 5 days so catastrophic? Because modern global manufacturing operates on just-in-time, or JIT supply chains. A modern Ford truck requires roughly 3,000 individual chips. Ford doesn't keep a 6-month stockpile of these chips in a warehouse. They arrive at the factory 48 hours before they are installed in the truck to save on inventory costs.
So, if Taiwan is blockaded, the chips don't ship. Day 3 of the blockade, the Ford plant in Michigan runs out of a single $5 microchip. Because the truck cannot be finished without it, the entire $50,000 assembly line shuts down. 10,000 auto workers are immediately furloughed.
And it cascades. The steel suppliers for Ford lose their orders, the glass manufacturers shut down, the local restaurants around the auto plant lose their lunch rush. Now multiply this across Apple manufacturing iPhones, medical device companies making pacemakers, and aviation companies building jets.
The sources predict that a mere 5-day blockade would cause global stock markets to violently crash and global GDP to contract massively in a matter of weeks.
It represents a non-military power projection that could completely cripple the global economy without firing a single ballistic missile. The economic threat itself becomes the ultimate weapon. And the sources deeply question whether the American public, already suffering from high inflation and internal division, would actually have the political stomach to send aircraft carriers to break such a blockade, risking a nuclear war over a supply chain issue.
Which perfectly transitions to the second global flashpoint, Iran and the Middle East. The sources describe the current U.S. involvement and posturing in the Middle East as its potential Suez Canal moment.
This is a profound, illuminating historical reference that we must unpack. In 1956, the British Empire, along with France and Israel, tried to exert military control over the Suez Canal after Egypt nationalized it. It was a projection of imperial power. But they were ultimately forced to humiliate themselves and back down. Why?
Not because they were defeated militarily, but due to international pressure and severe financial weakness. The United States threatened to sell off its reserves of the British pound, which would have crashed the UK economy. It was the exact moment the world collectively realized the British Empire was no longer the dominant global power. Its military threats were hollow because its ledger was weak.
And the sources are arguing the United States is facing that exact moment of geopolitical realization right now in the Middle East. The specific vital choke point is the Strait of Hormuz, a critical maritime passageway for a massive percentage of global energy supplies.
The U.S. has historically policed that region, implicitly threatening overwhelming military intervention if anyone disrupted the free flow of oil.
But the macroeconomic calculus has changed. The sources note that the U.S. population, deeply scarred by 2 decades of wars in Iraq and Afghanistan, is profoundly weary of foreign conflicts. They fear the immediate, punishing economic pain of spiking gas prices, and they fear the human cost of casualties. Therefore, the historical threat of massive, sustained U.S. military intervention is rapidly losing its credibility in the eyes of regional powers.
The sources make a very practical, brutal observation about the mathematical reality of modern warfare and occupation. They point out that Iran has a highly educated population of roughly 90 million people, situated in incredibly difficult mountainous terrain.
The idea of a foreign indebted power going in and successfully occupying and controlling a nation of 90 million people for a long period of time is mathematically and militarily nearly impossible. The financial pain, the domestic political cost, and the sheer number of troops required to enforce that control would bankrupt the declining power.
So, when a declining, indebted superpower is no longer willing or financially able to project overwhelming, sustained military force to protect global trade routes, the rules-based world order fundamentally fractures.
The power vacuum is rapidly filled by aggressive regional actors, global shipping lanes become insecure, insurance premiums for cargo skyrockets, and global inflation rises as the cost of doing business internationally explodes.
We have painted a picture of a 500-year cycle coming to its inevitable, messy, historical conclusion. Sovereign debt crises, margin calls, massive wealth gaps supercharged by AI, political dysfunction, capital controls, and waning global power. Do the sources offer any actual solution? Is there a mathematical way out for a declining nation to avoid the reset?
They do offer a solution, but they are honest historians, and they readily admit it is a massive, almost unprecedented long shot. The only historical way out of this late-cycle trap without a violent reset is for a strong, highly competent, bipartisan political middle to emerge.
For moderates who understand math.
Yes. Leaders from opposing sides who actually understand the macroeconomic mechanics we've discussed today, coming together to bravely implement a very difficult, deeply unpopular shared pain plan.
It requires immense compromise. It means raising revenues through smart, broad-based taxation, cutting entitlement spending in structural ways, and restructuring the national debt, all while aggressively investing to maintain the societal floor of education and infrastructure.
It requires the population to maturely accept shared financial sacrifice today for the long-term health of the nation tomorrow.
And given the extreme, visceral polarization the sources described earlier, where the political left and right are literally at each other's throats over a shrinking economic pie, a bipartisan shared pain plan seems highly, highly unlikely.
It does. It requires a level of political courage that is rarely seen in the late stages of an empire, which is why the sources ultimately and pragmatically circle back to the individual. If the nation-state cannot manage its decline gracefully, the smart individual must act globally to protect their family. The sources use a fantastic, memorable phrase. You must be a smart rabbit with 3 holes.
A smart rabbit with 3 holes. I love the visual of that. What does it actually mean in practice for you, our listener?
It means you absolutely cannot tie your entire financial, physical, and personal future to a single geographic location or a single failing sovereign system. You must look globally for what the sources term Renaissance states.
You look for regions or specific countries that currently possess the healthy macroeconomic markers we discussed earlier. A strong societal floor of good education, low debt-to-GDP ratios, civil discourse, high technological productivity, and cultural vibrancy.
You spread your risk. You diversify not just your stock portfolio across asset classes, but you diversify your geographic footprint and your legal residencies.
You become a sovereign citizen of the world, intelligently navigating the shifting tectonic plates of global power.
Precisely. You step outside the collapsing cycle.
This has been an incredibly deep, exhausting, but utterly necessary journey through some of the most powerful predictive source material we have ever covered. We started by looking closely at the micromechanics of an AI tech bubble, breaking down how margin calls and the illusion of paper wealth can quickly evaporate, dragging the real-world economy of restaurants and factory workers down with it.
We then zoomed out to examine the macro 80-year historical debt cycle, identifying the 3 converging mechanical forces of maxed-out sovereign debt, internal political conflict over wealth gaps, and the shifting of geopolitical power when the center cannot hold.
We rigorously explored the terrifying productivity paradox of AI, the reality of technology automating not just human muscle, but human cognitive reasoning, detaching labor from capital, and the urgent mathematical need for society to establish a baseline floor of education and care to prevent systemic, violent collapse.
We extracted a highly pragmatic, personal survival guide, emphasizing the absolute mathematical necessity of diversification, the hidden dangers of holding cash due to real yields and fiscal dominance, the historical utility of gold versus the quantum and regulatory risks of Bitcoin, and the career imperative of partnering with AI to reach the top 10% of your field.
And finally, we watched the shifting tectonic plates of global superpowers, analyzing the UK's Liz Truss bond crisis as a late-cycle cautionary tale, the inflationary dangers of wealth tax capital flight, and the geopolitical flashpoints of Taiwan's semiconductor supply chains and Iran, signaling the definitive end of a single-power rules-based order.
It is a sweeping, objective, macroeconomic view of the world as it actually functions.
It is intimidating. There's absolutely no denying that. The math is heavy. But I want to remind you, the listener, of something crucial. While these macroeconomic forces are massive and historically deterministic, your greatest, most powerful asset in this changing world is your individual adaptability.
By listening to this deep dive, by deeply understanding the underlying mathematical mechanics of these 80-year cycles, you are no longer a passive victim reacting to random chaotic headlines on your phone.
You are an informed navigator. You can see the actual gears turning behind the clock face. You understand why the margin call pops the bubble, why the bond market breaks the politics, and why the global power shifts. And armed with that exact mechanical knowledge, you can position yourself, your career, and your portfolio to not just weather the storm, but thrive in the transition.
Knowledge of the cycle's mechanics is the ultimate defense against it. But before we sign off, I want to leave you with one final, highly provocative thought to mull over on your own as you digest all of this. Throughout this entire deep dive, based strictly on the historical source material, we've discussed the shifting of power from one nation-state to another, the transition from a U.S.-led unipolar world to a fragmented world of regional sovereign powers like China or India.
The standard 500-year historical geopolitical model.
Right. But let's connect two very different gears of the machine we've discussed today. The source has firmly established that artificial intelligence is the ultimate driver of the new economy, destined to replace the human mind and generate unprecedented, almost unimaginable productivity and wealth. But that advanced AI, the physical data centers, and the energy grids required to run it are not owned by any government. They are owned and controlled by a tiny handful of stateless, borderless, ultra-powerful tech conglomerates, the capitalists who privately deploy the algorithms.
So here's the terrifying question. If we are truly entering an era where human reasoning is fully automated and the vast, overwhelming majority of global wealth, surveillance capability, and operational intelligence is concentrated entirely in the hands of a few private tech monopolies, will the next world order even be dictated by countries, presidents, and regional governments? Or will this 80-year cycle end with the stark realization that the new global superpowers aren't nation-states at all, but the borderless corporations that control the superintelligence? Keep an eye on those specific gears. We'll see you next time.